Hello again, everybody. We are looking at Chapter 7, which deals with standard costing and variance analysis. Up to this point, we've kind of assumed that we're only trying to figure out the cost of a product after it's been manufactured. We take our direct materials, we take our direct labor, our overhead, and kind of add them all up, and we get the product cost, and we do that after we've already made the product. In the real world, a lot of people like to figure up the cost of the product before it's even made, and then they kind of compare what the product should cost to what it actually costs, and that's what standard costing is. So here's kind of what we talked about already: direct materials, direct labor, overhead equals product cost. In standard costing, it's the same idea, but we develop standards: what the direct materials ought to cost, how much labor ought to go into the product, how much overhead the product ought to take. And then we take all those together to get a standard product cost. And the reason we do that is so we can manage it. There's an old saying in business: you can't manage what you can't measure. So what happens in standard costing is we develop this standard of what the product should cost, and then we compare it to what it actually cost. And then we can look and see if there's any variances between the two. And there's always going to be some kind of variance, but what this does is it allows us to pinpoint exactly where the variance is. Is it in materials? Is it in labor? By pinpointing it and finding the variance, we can manage it. So our problems in Chapter 7 all have to do with how do we handle variances between the standards that we've developed and what actually happened. So we're looking at the problem here. I'm going to bring up the question, and if you want to pause and kind of read through that, we are going to be working and trying to find variances between our standard direct material and our standard direct labor. And we'll also show you how to do the journal entries for it. So now that you've had a chance to read over that, let's get right to it. Part A wants us to compute a material price variance and give a journal entry. Our material price variance is simply calculating how much we had set up as a standard for our material price and how much we actually ended up paying. So here's our formula. We're going to take the actual price we paid multiplied by the actual quantity we bought minus the standard price that we've set times the actual quantity that we paid for. Okay? So our problem, I've got that information right down here. I copied it directly from the problem. First item we need to know is our actual price, and it doesn't come right out and give it to you. We need an actual price per unit. So if we look here, it says during the quarter the company bought 17,000 yards at a cost of $83,300. So to get that actual price per unit, we need to take $83,300 and divide it by the 17,000 yards that we bought. So I get an actual price of $4.90 per yard. And then all we have to do is take that and multiply it by the actual quantity that we purchased. AQP is actual quantity purchased. So equal 490 times 17,000 gives me 83,300. That is what we spent in real life on the material that we had to buy for the product. So let's compare that to the standard. The standard price that we expected to pay was $5 a yard, and we see that right there, direct material standard, $5 per yard. We're going to multiply that by the actual quantity that we purchased, 17,000, and we get 5 times 17,000 equals $85,000. So we expected to pay $85,000, that's our standard. We, in reality, only paid $83,300. So I'm going to subtract the standard from the actual, and we get a $1,700 difference. Now we're going to label that favorable because we expected to pay $85,000, we only paid $83,300. That's a favorable variance. Now don't necessarily think that favorable is good or bad, it's just favorable. We spent less than what the standard was. Okay? So from a journal entry standpoint, we need to record the raw materials inventory coming in, we need to record the payable, and then we're going to record the variance. Each of these three numbers is going to get recorded in a journal entry. So we would book raw materials inventory as a debit, and we're going to debit it $85,000. We actually debit that for the standard amount. We're going to have a credit to accounts payable for the actual amount, $83,300. That's the amount that we owe our vendor. The offset is going to be to material price variance, $1,700. So you can use that same setup for every one of your problems where you have to calculate a material price variance. This material price variance that we have, that 1700, that eventually gets closed out the cost of goods sold. So if you ever have to close that out, if it's immaterial, it gets closed out the cost of goods sold. So let's look at part B, material quantity variance. How does our actual amount of material we used compare with how much we were supposed to use? So we got the information there for that one. Our standard price, we figured in the previous problem, and it's given here, $5 per yard. We can go ahead and plug that in. Now AQU is the actual quantity that we used. It tells us in the problem we used up 16,500 square yards. So 16,500, we're going to multiply that by $5. 5 times 16,500. We used $82,500 worth of material. The standard that we were supposed to use was 10 square yards per item. So we made 1,500 curtains, 10 square yards apiece. That standard would be 10 square yards apiece times 1,500 units is 15,000. We do the math on that. 5 times 15,000 gives me 75,000. 75,000 was the standard. We ended up spending 82,500 on the material. So we have a negative 7,500. That is an unfavorable variance. The standard ended up being a lot less than the amount we had to use, the dollar value of the amount of material that we used, to the tune of 7,500. So again, the journal entry, if we were going to journalize that, the numbers are all right there that we need. We'll have work in process inventory. That represents the standard amount that got put into production. We'll credit raw material inventory, and that represents the actual amount of raw material that got placed into production. So the debit's the standard amount, the credit here is the actual amount that got put into production. The difference, you'll notice we need to, debits and credits need to equal, so we need to plug in a material usage variance of 7,500. That ties it all together and makes it balance out. So that's how we calculate material price variance. How does the actual price of what we bought compare to the standard? And material quantity variance. How does the actual amount that we used in production compare to the standard? The next one we're going to look at is a labor variance. So if you kind of see where we're going here, standard direct materials, we just figured out the price and quantity variance there. Now we're moving on to labor. After we do labor, we'll look at overhead in a separate problem actually. So here's labor variance. The calculations are basically the exact same. The terminology is a little bit different. Instead of a price variance, we just say a rate variance for labor. Same idea, labor rate, labor price variance, and then labor quantity variance. So calculating the same thing, formulas are pretty much the exact same. So let's go ahead and tackle this one. We're looking for an AP, an actual price of labor. So the problem tells us direct labor in reality totaled 79,800 for 7,600 hours. So I'm going to go and put in equal 79,800 divided by 7,600. Our labor rate in reality is $10.50 per hour. We're going to multiply that by the actual quantity of labor that we had in the problem. So equal 1050 times 7,600 will take you right back to that 79,800 number. That is the real actual amount that we spent on labor. Our standard price for labor was $10 an hour. That's a standard. So we're going to plug that number in there, multiply it by the actual amount used, and I get 10 times 7,600 equals $76,000. Our standard was $76,000. That's what should have been spent. In reality, we ended up spending $79,800. So again, that is an unfavorable variance. So let's label that unfavorable to the tune of $3,800. The quantity variance, how much actual labor did we use quantity-wise? Standard price, we'll plug it in right from the top, $10 and $10. We're going to multiply that by the actual quantity that we used, 7,600. 10 times 7,600 gives me $76,000. Our standard quantity is going to be 5 hours per times 1,500 units. So 5 hours per unit, 1,500 units. 5 times 1,500 gives me 7,500. Multiply that by my standard, and I get a standard of 75,000. So I'm going to take my 75,000 minus my 76,000. I get an unfavorable variance of $1,000. Now you could also take the total variance here for labor by adding that 3,800 into the 1,000, and that would give me a total labor variance of 4,800 unfavorable. So if you're ever asked how to calculate the total variance for labor, that's basically the idea. You'd take the rate variance and the quantity variance, smush them together. So let's talk about journal entries. How would we journalize that? So I've got that same information up here. I've just copied it over. Again, all the numbers we need are going to come from our problem that we just kind of calculated here. So we'll have work in process inventory for our standard amount, 75,000, comes from right there. Then we'll have wages payable of 79,800. That's the actual amount of wages that we incurred, 79,800. The difference is going to be our two variances here, and they're both going to be debited. We have a labor rate variance, 3,800, and a labor efficiency or quantity variance of 1,000. So that's how we journalize that. And again, we'd close our variances out to cost of goods sold. So like I said, in a standard costing environment, it's kind of strange to think of, but we actually go ahead and make a journal entry for the standard and the actual amounts. And those differences, those variances, get closed out to cost of goods sold. So that's really all the problem wants to know. If we look at the prompt that we had on E, it says comment on the above variances. So they want us to kind of analyze those variances and give our thoughts on it. So let's start with the material price variance. If you'll notice, we had a $1,700 material price variance. Now what that means is we paid less for our material than the standard. So offhand you would say, hey, good job purchasing manager, you maybe got a good deal on that. And maybe that's true. Maybe you got a discount for buying in bulk. Maybe you worked out a good sale with the vendor and got a good deal. Or it could be possible that you bought lower quality material. So let's just assume for a second that we bought lower quality material. If we buy low quality material, we may end up having to use more material, or our employees may have to take longer to work with it and get it to where it needs to be. So if we follow that line of thinking that we didn't really get a sale or a good deal, we just bought crappy material, let's look and see what happened here. Quantity variance, notice, was 7,500 unfavorable, meaning we took more material to do the job than the standard allowed for. So that would fit in with the idea that we bought lower quality material. Since it was lower quality, we had to use more of it. Let's look at the labor variances. Notice we had an unfavorable quantity variance, meaning we put more hours of labor in than the standard allowed. So again, that goes back to that poor material. If it's bad material, it takes our people longer to work it and kind of get it to where it needs to be. So that would fit in with that also. The labor rate variance, a lot of times if you see an unfavorable one there, it doesn't necessarily point to poor material per se. We're just looking at the difference in the standard wage rate and what was actually paid. So if what was actually paid ended up being higher, it could be maybe we had to use more skilled labor than what we normally would. Maybe it's a really tight labor market and we started having to pay people more. Another issue, maybe it could have been a deal where we renegotiated a contract for a higher wage, but we haven't updated the standards yet. So those are just a couple of hypotheses as to what might have happened. If you have any questions on how to do the problem there, direct material and direct labor variances, let me know. One tool that I will show you that I kind of put out there to help you, if you go to Blackboard, I've tried to give you a template to help you work these problems. We'll do overhead variances in the next problem, but if you go to weekly chapter modules in Blackboard, go down to week 7, right at the top I've got problem template, variance analysis. If you click on that and download that file, what I've done is I've put all these formulas in a worksheet for you. Material variances are there, labor variances are there, overhead variances are there. Okay? So we'll get to the overhead ones in the next problem, but you can use that, and I've actually put a couple different tabs at the bottom. They're all the same, but you could use that for potentially 3 or 4 different problems. So if you have any questions on that, let me know.